Hello, this is Tony Marino, CEO of Tenaz Energy. Welcome to our Q4 and year-end 23 update. I would ask you to first note our advisories that we have at the beginning and the end of this presentation. I'm going to start with a review of our operating and financial results for Q4 and the year as a whole. This was the best operating quarter in the history of Tenaz. In Q4, we achieved a record production level of over 3,100 BOED. This was 32% higher than we had in Q3. Looking at the year as a whole, production was over 2,400 BOED, more than double our level in 2022. A lot of this production increase was driven by a very successful 4-well drilling program that we executed in Alberta. The average rate from those wells was 225 BOED per well during Q4, and importantly, the product mix was 89% oil. Having this valuable product representing such a large part of the mix definitely improves the economics of these wells. We closed the XTO Netherlands acquisition at the beginning of the third quarter, and this contributed significantly to our Netherlands production of 1,100 BOED in Q4, a little bit higher than the number that we recorded for Q3. Looking at FFO, or funds flow from operations, for the year we achieved $28.9 million, $1.05 per share, which was 235% higher than 2022. Net income for the full year in 2023 was $26.5 million, or 97 cents per share, and that up about 5x compared to 22. At the end of 2023, we had adjusted working capital of $49.3 million, $1.84 per share, and in addition to that, for liquidity, we have an undrawn $10 million credit facility. During the year, we repurchased 1.3 million shares of Tenaz at an average price of $2.97 per share, bringing our cumulative retirement of shares to about 6%. Finally, TNZ was one of the top performing stocks on the entire TSX in 2023. Our TSR was 83%, and that placed us in the top 1.3% of all TSX listed issues. Let's next review our year-end 2023 reserves. This is an independent report by McDaniel & Associates with an effective date of December 31, 2023. PDP reserves were up 22% year over year. That represented a 161% replacement of production at an organic recycle ratio, or an F&D recycle ratio, of 2.2 times. At the 1P and 2P levels, reserves were up 6 and 7% respectively. At the 2P level, we replaced 195% of production, and using FD&A cost, including FDC, we achieved a recycle ratio of 2.5 times. In doing that calculation, we accounted for the XTO acquisition at a zero purchase price. In fact, in that transaction, we received $46.5 million of positive working capital. Had we used that number, we would have, to do this FD&A calculation, we would have actually calculated a negative FD&A cost and a negative recycle ratio. We elected to make that calculation on a little bit more conservative basis, using a nil price for XTO rather than the negative $46.5 million, and that's what resulted in this actually still quite strong recycle ratio of 2.5 times. After tax, NPV 10 of the reserves was approximately $142 million at year-end 23. That number up very slightly from the year-end 2022 ATAX valuation. We achieved that very small increase, though despite much lower pricing for both TTF and ACO gas in the consultant average price decks that are used to value the reserves. Our 2P Reserve Life Index, or RLI, was 12.8 years, doing that calculation on the much higher production rate that we had during Q4 2023. In the charts at bottom on the left, you can see the distribution of our PDP reserves by country, predominantly in Canada, although a meaningful contribution from Netherlands. And then if you look at the chart in the lower right, you can see that we've had quite strong production growth in all of the years since the recapitalization of Altura, and that strong growth has occurred at all three reserve categories that are shown here: PDP, 1P, and 2P reserves. Let's put that performance for 2023 in the context of Tenaz overall record since we made the recapitalization of Altura in Q4 2021. Production has been up threefold during that time. We've had an eightfold increase in FFO, and that is driven both by these higher production levels and by an improvement in the product mix and higher product prices for oil, improving our margins. At the same time that we've had these increases in production and in FFO, we've had an increase in our positive working capital balance. Altura had a very slightly negative balance at the time of the recapitalization. We paid off that debt, and we have increased our adjusted working capital to the current level of nearly $50 million. In addition, we have that undrawn bank line. And as I mentioned earlier in the presentation, these increases in production, FFO, and adjusting working capital have been achieved at the same time that we have had a buyback program that has retired 6% of the Tenaz share count. Next, let's take a look at our outlook for 2024. Starting with the lower right panel, we are guiding to average production of 2,700 to 2,900 BOED during 2024. We expect to achieve that production level on a D&D CapEx, or drilling and development CapEx, number of $23 to $25 million, and that would be based on a 4 gross 3.5 well drilling program in Canada, along with well work and facility activities in Netherlands. If you look at the pie chart for the production mix on the lower left, about 43% will be Canadian oil and liquids, 38% relatively high-priced TTF gas in Europe, and the remaining 19% AECO gas in Canada that comes along with our oil production as solution gas. Activities for 2024, I already mentioned that we'll be drilling 4 gross 3.5 net wells in the Rex at Leduc Woodbend, a budget that is intended to give us flexibility to go up or down in the size of the program depending on conditions, deliver significant growth along with free cash flow. In addition to that D&D CapEx, we project $3 million of E&E CapEx for the Netherlands CCS project. This is for additional front-end engineering and design aspects of the project. By mid-year 2025, when this FEED phase is over, we expect to be able to make the final investment decision on this project after having this better estimate of costs and economics as a result of the FEED design phase of the project. With respect to hedging, we have fixed the price for about 40% of our Q1 volume at $24.12 per MCF. For the summer Q2 and Q3 season of 2024, we've hedged 20% at $14.71 per MCF. And finally, we've hedged about 25% of our projected volume for AECO in the winter 24-25 season at $3.28 per MCF. And of course, in addition to these producing activities, we will be continuing our disciplined M&A efforts, targeting acquisitions in our identified regions of focus. Let me elaborate a little bit on this international M&A strategy. We are targeting the acquisition of conventional producing assets in our main regions of focus. In addition to conventional production, we think that there will be some opportunity to generate semi-conventional projects as well in these acquisitions, something that hasn't been pursued as aggressively overseas as it has been in North America. The three primary regions of focus for us are Europe, Latin America, and Middle East North Africa. We have some optionality for Canada, but wouldn't expect a large acquisition program, perhaps very, very small transactions adjacent to our existing field in Leduc Woodbend, and beyond that, I don't think we'd be doing that much more in Canada, and presently no targeting of the U.S. The reason that we believe that these international jurisdictions are more favorable for our acquisition program is twofold. First of all, there's less competition, leading to better multiples at lower multiples at acquisition, higher base rates of return. And secondly, we think there's a greater opportunity to make operational improvements, better production profile, and lower unit costs versus the current operations. That's been our experience in the past. And based on what we see in the evaluations that we're currently conducting, we think that it'll be true for the ongoing stream of acquisitions as well. Put those two things together, better multiples at entry and greater opportunity for operational improvement should lead to higher returns on capital than we would see in a North American acquisition program. And finally, we intend to continue to emphasize ESG and sustainability as we've done in the past. We think that this will give us better acceptance into these international jurisdictions and will also improve our operating results. So that is the update on our Q4 and year-end 2023 results. Again, what I believe to be the best operating quarter in the history of Tenaz. We're looking forward to talking with you again when we present our Q1 2024 results. Thank you very much for your interest in the company. Goodbye.